Good afternoon, everyone, and thank you for joining. We're going to let everyone continue to log on and get started in just a couple of minutes. All right, it is 3:02, so we'll go ahead and get started. Hi, everyone. Thank you for joining us for today's webinar, Top State and Local Tax Challenges for the Healthcare Industry. Today's program will be presented by Jim Bartek, Partner and Market Leader, Jason Rosenberg, Senior Manager, and Bonnie Susmano, Manager in Withum State and Local Tax Services team. Before we begin, I have a few notes. Today's materials can be found in the toolbar on the right of your screen and will be distributed to you after the program. Also, at the bottom of the toolbar, you will see a questions box. Feel free to send us your questions during the presentation. We will do our best to address them during the presentation or at the end. There will be 4 polling questions throughout the program. To qualify for CPE credit, you must participate in each poll. CPE certificates will be emailed to you within a few weeks. And finally, once the webinar is over, there will be a pop-up asking you to complete a survey of today's webinar. Please take a moment to complete it. It is our way of being able to provide you with the best and most relevant programs possible. I will now turn it over to Jim.
Thanks, Rachel. So welcome to the Withum Healthcare series, webinar series, Top State and Local Challenges for the Healthcare Industry. Today, again, we're going to be talking about industries that are important to you, with many outside influences projected to affect state revenues and pressure to provide the state services. The states are taking aggressive tax positions and increasing audit activity. Therefore, during the session, we're going to cover some areas of risks and possible opportunities we see with our clients as states look to keep their revenues high. So with me today, as Rachel had mentioned, again, I'm Jim Bartek, leader of the State and Local Tax Group at Withum, and I'm joined by Jason Rosenberg. He's the Senior Manager of State and Local Income Tax and also leads our income tax practice. And then Bonnie Susmano is a manager focusing on sales tax. So during this section, the next slide, please, Rachel. So during this session, we're going to talk about the current climate of state and local tax. Basically, we want to give a background of how the states are doing since the pandemic. Then we'll give some highlights regarding some areas where we see some common sales and use tax issues, such as sales to healthcare entities, missing exemption certificates and so forth, as well as sales by healthcare companies, because we're seeing that more and more. We'll also discuss the state sales and use tax audit issues we're seeing out there with some of our healthcare clients. Then Jason's going to discuss state and local tax pass-through entity taxes, or workarounds, and discuss some state attempts to circumvent the SALT limitation in the Tax Cuts and Jobs Act. Jason will also talk about the issues our clients have been dealing with related to telecommuting And then we'll also discuss what we're seeing with telehealth in the SALT arena. And we'll wrap up with a brief summary of what you should do to deal with these issues. Just a reminder, please send in questions and we'll answer during the session or after the session if we have some time. If we don't have time, we will send you an email response with our answer to your question. So again, please send in questions throughout the session. Okay, next slide. So let's start with the current landscape of state and local tax. Now, it's important to understand how the pandemic affected the state and local revenue so we can understand how the states will react moving forward, including how states will enforce their taxes. With that said, which states do you think are the best and worst states rated for business climate? Probably not much of a surprise, but next slide, Rachel. So this hasn't changed much from last year. The worst is my home state of New Jersey at number 50. Not something I can be proud of as a New Jersey native, but there are high income taxes, high property taxes. Sales taxes are average, but they do impose sales tax on a lot of services. So we do have great schools and excellent healthcare here. New York's at number 49, same as last year. High income taxes, high sales tax, tax services are tough, tough to get a hold of. Very aggressive audit state with offices around the country. And then California is at number 48. Again, they have high income taxes, high sales taxes. They don't tax a lot of services, but they are aggressive. Now the best ones are Wyoming, basically states with one or more tax that they don't impose. Like Wyoming does not have an income tax, South Dakota no income tax, but they do have a sales tax on basically everything. Alaska's number 3, no sales tax. Florida is number 4 and has no personal income tax, but they do tax a lot of services on the sales tax side. If you're wondering, Texas fell 1 from last year, so they're down to number 14. They're a high sales tax state, very aggressive with audits, no personal income tax, but again, very aggressive. And Pennsylvania fell 2 from last year, and now they're number 29, middle of the pack. So what is the largest source of tax revenue for states? Next slide. So in 2019, I wasn't able to find one for 2021, but it hasn't changed that much. Individual income taxes heads this up at 41.5%. The states do rely on the individual income taxes. That's why we'll spend a good amount of time later on pass-through entities and telecommuting. Jason will talk about that later. Now, consumption taxes like sales tax, gasoline tax, and so forth are at 17.6, a very large portion of state revenues. States like Florida, who don't have an individual income tax, rely more on the sales tax. Now, note corporate income taxes are only 3.9% of states' revenues, but as a reminder, pass-through entities like partnerships, for example, revenue is taxed at the individual level. So next slide, please. This chart just shows how high sales taxes are in the states. So you can see here, sales tax rates are pretty high across the country. So you want to, if you make the wrong decision on taxability of an item or whether you should be paying sales tax for your corporation, then you could be on the hook for a large amount. Next slide. Gross receipts taxes could be the way of the future. They're more regressive. This allows states to measure state revenue more effectively year over year and budget better. These taxes are mostly based on market, like where it's sold to, so they're more predictable, like sales tax for budgeting purposes. States like Nevada, Washington, Ohio, Texas, Oregon. There's also cities that have these taxes as well, like San Francisco, Seattle, LA. And again, I do want to note that some of these cities and states have been very aggressive with sending notices to our clients. When we perform due diligence for our clients, we do frequently find risks here.
Yeah, Jim, I think that's those are really good points, because I just want to highlight how cost prohibitive these taxes. We're always seeing them on a due diligence, because as we know, even if there's a loss company or break-even company, right, businesses right that have high production volumes and low profit margins, right, they're going to be hit the hardest. And so yes, the tax rates are low, but they are taxing gross receipts without any consideration of expenses. So these states always come up either on audit or a due diligence. So just something to be careful of. And as Jim mentioned, I agree. I think more states are going to go this direction, especially as we see an economic downturn, possibly in the next, in this current environment over the next 12 to 18 months. You never know. You could see additional states at least proposing or considering these kind of taxes.
Absolutely. And next slide, Rachel. Good points, Jason. So this chart was published in April of 2022 by the Tax Policy Center. Now, state revenue growth was strong in fiscal year 21. If you look at the orange bar, it's 17.6%. A good portion was related to shifting revenue between 2020 and 2021 due to returns delayed. Most states' fiscal years end in June, so when you moved it to the return due date to July, the IRS and then the states followed, of course, the revenue was moved to the next year for most states, next fiscal year, we'll say. Again, those are medium blue and light blue bars. Sales tax was up due to the economic nexus rules. Bonnie will discuss those later. Those are dark blue, 10%. Some would argue that the economic rules saved revenues in fiscal year 20 because everybody was online shopping, including me. At this time, though, before April 15th, when this was published, it appeared revenues would be weaker than expected in fiscal year 22 for most states. However, some of the states, as we'll talk about New Jersey in a second, were actually a little higher. Now, sales tax revenues did increase, of course, however, possibly due to inflation, because higher prices, higher sales tax collections. But the outlook is fuzzier in 2023, and inflation adjusted, this could be actually a decline if you look at the bars all the way to the right. And this could actually be a decline because there's many uncertainties like a pandemic, geopolitical crises, high inflation, federal monetary policy. There's a lot of uncertainty. Next slide, please. And of course, this is why the states are going to be looking for new ways to recover some of the revenue. Now, for New Jersey, the fiscal year 20 revenue was $38 billion. In fiscal year 21, it grew 13.4 billion to 51 billion in 2022. So from fiscal year 20, it was 38 billion that went up 13 billion to 51 billion. So again, this is above what they had forecast just in March, but basically had some high spikes in April tax payments and could be due to financial markets and overheated economy in 2021. Now, New Jersey bait and gross income tax collections were strong in March and April. So obviously that accounted for a large portion of the upward revision. New York and Pennsylvania are also up. Just wanted to point that out. Now, also for next year, the stock market is 20% down. NASDAQ is down 30%. So again, states are projecting lower revenues next year. Next slide. Jason, you want to cover income tax trends?
Yeah, sure. So there really has been an unprecedented change in state and local tax, right, the last several years. And these are some of the biggest trends that we're seeing and we expect to see in the SALT income tax landscape the next few years. And real briefly, I could go through some of these. So in terms of the nexus standards, right, economic nexus for income tax prior to Wayfair was generally considered the law of the land, adopted, by most states for income tax. But now at Wayfair, what we're seeing is that states are formally adopting economic nexus, either by statute or administratively. Where states might have enforced it just on audit, they're ramping up or beefing up their statute or their guidance to make sure that it's codified. And as a result, we're seeing an increase of audit enforcement, and we expect, especially in this economic downturn that many economists are forecasting, we expect audit enforcement is only going to increase as we look at the next 18 months or so. So economic nexus is here. It's the law of the land for both sales tax and now income tax has just been it's just being codified in many states, although it's been in existence for quite some time. In terms of rates, we've seen a lot of changes. Actually, I would say that this is a huge trend as of 2022, and it's really an income tax reduction trend, especially in the South and Midwest. We've seen a lot of states either enact or propose tax rate reductions in a number of states. And again, we expect this trend to continue. A lot of states do have budget surpluses. And we've seen some states decide to return some of these budget surpluses in the form rebate check, but many other states are, permanently cutting taxes. But something to keep in mind, right? Obviously, as economic conditions, change in the present time, states might look back at some of these reductions, and we'll see if there's any, pullbacks from some of these proposals that are out there, or some of this legislation that's been enacted. If there's any pullback on some of these reductions that might be out there, but so far, generally good news. And in terms of the expansion of tax base, states are always looking for new ways to enhance their revenue. And so we're seeing unique and creative ways for states to continue to adopt, what we call combined reporting and unitary reporting, and looking to tax foreign affiliates. So this has been a hot topic, especially on audit. We've seen that this issue has come up in many cases. And, I'd say with exporting the tax burden, this is probably one of the most significant ones on this list. And this has really been a trend in state tax for the past decade. And we've seen continued acceleration of this. And really what this means is that what's happening is states are adopting single sales factor apportionment, and they're adopting market-based sourcing. So there's less reliance on the payroll and property factor. In-state presence is less of a reliance when computing taxable income. And what's happening is that as you adopt market-based sourcing, you're looking to where the customers are. And so you're really exporting in-state tax on businesses that are in-state to taxing out-of-state businesses by going to a single sales factor, which is just based on revenue, and sourcing that revenue to states just based on where the customer is, not where the costs are incurred to generate the revenue. So this is a big trend, and we'll talk about in a little bit more detail today as we get through the presentation.
Sure. Next slide, Rachel. Yeah, so we'll go through this quickly. Sales tax expansion, depending on how the states do financially, they can add sales tax to different services through legislation. Obviously, there's some room to go. Some states don't tax a lot of services, like California. They could add this. Of course, software as a service is not taxable in over 20 states. They could add that as well. There's digital goods services, advertising, such as Google. Maryland came up with a digital advertising tax. We talked about GRT taxes. Financial transaction taxes have been proposed in several jurisdictions, so look at for those in the future. Excise taxes on gas, nicotine, cannabis, hidden taxes like that. CEO pay tax, a couple jurisdictions we're looking at that, and unclaimed property, which we'll talk about in a little bit. Jason had mentioned increased audit activity. Next slide. So now, before we get to Bonnie on sales and use tax, again, a couple of things we're going to talk about is sales to healthcare entities, sales by healthcare, not-for-profit entities and for-profit entities, and state audits. But first, I believe we have a polling question.
Yep, so we are on to our first polling question. Have you renewed your Pennsylvania exemption certificates in the past 5 years?
Okay, so it's again, yes, no, or I have no idea, or why do I have to renew the certificate? Let's see how people are answering. Obviously, if you're not in Pennsylvania, you wouldn't have a certificate. And this is something that Bonnie will talk about as well.
In about 30 more seconds.
Okay, we have a lot of no's, and we have 28%. I have no idea. So this will be pretty timely, Bonnie.
Yeah, indeed. Yeah, the exemptions are always tricky, not just with not-for-profits, but with any company, because it comes up a lot on due diligence, and it just comes up a lot with our clients in general, because a lot of our clients don't always know when do they need to renew their exemption, or how long do they need to hold on to their exemption certificates that they collect. Sometimes our clients are, a group of affiliated entities, and they think because they have one entity that has a sales tax certificate of exemption that it applies to all the entities, and it doesn't. Basically, when there's a whole group of entities and one entity has the exemption, it's only good for that particular entity. Each entity related or not, each entity has to have its own exemption certificate. And this is often very confusing for clients, but for sales tax, each entity is always required to have their own sales tax registration and exemption certificates. Now, to know, a lot of states have different rules as far as when a certificate expires. You know, the good news is New Jersey, the certificates don't expire, but in Pennsylvania, they do expire and they need to be renewed every 5 years. And this is often overlooked or forgotten about, but it's important because they do expire every 5 years. And like New York, for example, they're only valid for 3 years. And New York usually will send out a notice for renewal 2 months prior, but the burden is on the taxpayer to renew according to whatever period is required based upon the state. Now, what's also important to note is that if there is non-compliance, there's exposure. And I see this a lot on due diligence where a target company says, oh, well, my sales aren't taxable. Everyone's got an exemption certificate. Well, it's only exempt if you have that certificate in hand and on file. Otherwise, it's considered a taxable sale. Now, admittedly, on audit, auditors will generally give you time, the client time to obtain those exemption certificates, but why be in that position and why be stressed about getting those exemption certificates? Furthermore, I find that clients often have to go back a few times to get a hold of clients to get them to respond. I also find that sometimes clients will go back to a company and they're no longer in existence. So in order to avoid that, if a sale is exempt from tax, it's better to get that exemption certificate from the customer and have it in hand at the time of sale. Otherwise, I recommend
in this case, as your vendors are going to be asking you for the exemption certificates, so that's what Bonnie's talking about here.
Right, whether sale or if you're purchasing, that's right. Absolutely. It's always better to have it on hand and ready to provide or to obtain on a sale. Either way, it's better to have it in hand. So it just avoids any confusion or problems later on. In addition, there can be also saving opportunities can exist if sales tax was paid by an exempt entity for exempt purchases because maybe they forgot to provide the exemption certificate and so sales tax ended up being paid. If there was any confusion about what should be paid, sometimes exempt entities end up paying accidentally. So it can really avoid any confusion because we often find clients will say, oh, well, that customer turned out to be an exempt customer. You know, what do we do in those instances? Do we provide a refund and then go for a refund with the state? You know, there's different ways to handle matters with refunds. In general, it's the one that remits the tax that goes for the refund, but it does vary by state, and it creates confusion. Again, another reason for having it on hand at the time.
Now, we've had a couple of situations where clients, not-for-profit clients, have paid tax on certain items. It's just not part of their policy. So it's very important to get a process together where you're actually issuing a valid certificate on file. So I'll just give you 2 examples. One client of ours had paid sales tax on telecommunications charges, and they may not be taxable in a particular jurisdiction. So again, there could be some opportunities for refunds here. Also, as Bonnie had mentioned, Pennsylvania's certificate does expire. So we've had some clients with several entities and not necessarily have a process to update their certificates periodically to make sure that they are valid. Okay, so just important that you have that process. We have had some state audits that Pennsylvania coming in and you know, assessing clients that have not re-upped their exemption certificates.
That's right. It's often a problem, and it's easily overlooked. That's why it's important to get policies in place. In addition, we do have some for-profit entities. In New Jersey, we saw one of our exempt entities go from being a non-for-profit to a profitable organization. And on an audit recently, it showed that a lot of their supplies and things that they had purchased, they bought tax exempt. Now you're probably thinking, why, if they're no longer an exempt entity? Well, a lot of their vendors were used to them being an exempt entity. And in addition, it frankly was an oversight. So a lot of things that didn't get charged, that were charged, not charged sales tax on, should have been charged sales tax on, and things that a for-profit hospital should be paying, such as medical services in which the patient is paying for that medical service. Also things that you just don't think of, like cotton balls or tongue depressors or hypodermic needles, bed linens, cleaning supplies. Those types of things would be taxable. And on this audit, unfortunately, our client did not realize that had not been paid, the sales tax on those items. So it's important to keep in mind your status, whether you're exempt or not. And also, it's important that who's ever making these purchases properly checks the invoices to make sure that tax is appropriately charged when it should be. In addition, this also goes for medical facilities. Depending upon the state, certain medical equipment just off the bat can be non-taxable depending upon what it is. I know Pennsylvania has, certain items that they automatically consider non-taxable because I feel that Pennsylvania is very pro-people. Things that you wouldn't think would not be taxed might not be, and some are. Toothbrushes aren't taxable, for example, and certain medical equipment isn't either. So it really depends on the state, whereas in New Jersey, those rules are different. And in general, you have to look at each item, but also in general, most items are taxed. Next slide, please. As for sales by healthcare and not-for-profit entities, a lot of times clients don't realize that the way to have presence in a state for sales tax purposes is to have physical nexus or economic nexus. Now, a physical nexus is not just having a person in the state. It can be having inventory in the state. It could be having somebody visit the state for a couple of days for a trade conference. It can be having a vehicle in the state. It really just depends. Beware of Washington state, because if you step in that state one day, you've created a nexus for your company. So it really, it does depend upon what's happening. I had a client in New York who drove a moving vehicle to Florida and then out of Florida, and poof, they got an audit letter. So I said, does your truck have your logo on it? Yes. I guess some sales tax agent in Florida saw it because poof, they were audited. So it really, it can be established through physical nexus in a variety of ways that might not normally be thought of, and that's one of them. In addition, if a company has a server located in the state, that's another way. As far as economic nexus, I know Jason and Jim mentioned it earlier. It really depends upon the level of sales made into a state and or the number of transactions, and it's really just think of it as a way of leveling the playing field between brick and mortar stores and remote sellers. But the rules do vary by states, and it's getting trickier and trickier and harder for our small business clients to keep up with the rules, the change in the rules, and also the compliance efforts. So we're always, there to assist and come up with some creative ideas to be of assistance. In general, not-for-profit entities with nexus in a jurisdiction you generally have to collect sales tax if they're selling anything of a tangible nature or providing a service that's subject to tax. So thinking of, bookstores or software, different types of tangible items.
And
Also,
Bonnie, we've had some of our clients that have begun to develop software program and sell to other entities, for example,
that's right.
where they create in the healthcare space, create some sort of library, which could be a taxable information service in another jurisdiction. So again, there's always the myth that not-for-profits don't have to collect sales tax. That is a myth. They do have to.
That's absolutely right. Because we find that a lot of clients will create software and think, oh, it's not taxable, can't touch it. But that's not the case. And we're seeing it more and more on audit that clients that have software that's sold as a service are finding that it's taxable because they're simply, just by providing access to your software, no matter what it does, and that's paid access is, especially New York State's been very aggressive on this, that it's taxable. And, some states will look at like the level of control that the taxpayer has over the software, and some won't. It really depends on the state and the auditor as to how aggressive they'll be. But at the same time, if they don't get you on software as a service, they'll try for information, and they'll say, oh, are you selling information? What sort of information? And is it unique to your customer? So auditors are really aggressive now in trying to find ways to subject, any purchases and sales to tax. In addition, some states are very specific, and they'll say tangible personal property can be taxable, but also are certain enumerated services, which would be then defined by statute. And they'll also define and state, what else is exempt. But if it's enumerated, it definitely is or isn't. It would be enumerated. Next slide, please.
Yeah, and Bonnie, on the state audits, you can go through this quickly in the interest of time here.
Oh, sure. As for state audits, we're seeing a rise in audit activity now. You've probably all heard that a lot of states have had layoffs or early retirement packages, which is true. But at the same time, they've hired a lot of young auditors, or they're overloading the auditors that have stayed. And so it's leading to auditors being more aggressive because there's more interest in collecting revenue. So there's definitely been a rise in audit activity, and what I call trying to expand their view of sales tax and making it broader as to what's taxable. And there's definitely a lot more discussions happening on audits depending upon what our clients are doing and selling. So it's something to keep in mind. In addition, audits are often showing us that there's been non-compliance in keeping exemption certificates, or that there's a group of related entities and one entity doesn't have it, and it assumes that because one entity does, it's good for all of them, and that's not the case. And again, it's really tricky on audits to have to be in that rush situation to try to go back to customers and ask for an exemption certificate, and sometimes find out that they're not in existence anymore. The good news is for those clients of ours that have asked and found that some of our clients have direct pay permits, or they already remitted on an audit themselves. So it really just depends, but why be in that position? There are some common audit issues for healthcare entities. Items purchased sales tax free for use by related for-profit entities. That can occasionally be the case. In addition, sometimes there's a management fee between related entities, and that can sometimes be construed differently on audit as to whether it's really a management fee and should be something else and taxed. Sometimes there are shared service centers. We have a client up in Westchester who gets all the invoices for all the entities and makes the payment on them. And it's caused a problem because everyone, on audit thinks that the client in Westchester used the services or the software that was purchased and these subscriptions. And it turns out all the users are in usually Europe. And so it's a matter of proving all this because the burden of proof is always on the taxpayer. And so it's a matter of showing the auditor that it really wasn't used in New York State. And that also is tricky on audit. So proof is key. In addition, when you have a mixed-use asset, and how it's described, how it's invoiced, and whether it's taxable or not. In addition, COVID equipment and supplies, that's been a really hot topic because, during the pandemic, were test kits, what was taxable, what equipment was, and even now that we're still like coming out of COVID, so to speak, there's still questions. And now we're seeing, insurance companies saying it's covered by insurance, COVID tests, but there's been a lot of different questions about what's taxable, what's not, and in which state. In addition, other issues on audit are durable goods and items that are for resale, and is it properly documented, and are exemption certificates appropriately applied on purchase, payroll withholding. Those are some hot audit topics.
Next slide, Rachel. And I can handle this one, Bonnie, but basically a lot of these, we have clients, again, that may be for-profit or they're using a shared service center between, as Bonnie mentioned, between all for-profit and not-for-profit groups. So if they're developed for one entity and used by the other, it could be taxable in the for-profit entity. So either sales tax has to be charged or use tax has to be accrued if it's being paid by the not-for-profit entity. So what was purchased, where it was used, and which entities used. So next slide, Rachel.
Okay, we're on to our second polling question. Has your organization been audited? Yes, we were audited in the past. Yes, we are handling an audit right now. I have no idea, or never.
Okay, so we have 60%. I have no idea so far. And yes, we are handling an audit right now.
About 20 more seconds.
Okay, so we're getting 60% voted, 65, 77, 80%. You can be wrong here too. Don't worry about that. But 37% said yes, we were audited in the past, and 20% I have no idea, and 37% never. Okay. So unclaimed property. Let's cover this quickly as well, so we can get it off to Jason. If you're not familiar with unclaimed property, not-for-profit clients as well as for-profit clients are eligible to remit the unclaimed property. A lot of states have been sending out notices to not-for-profits as well. And again, just because you're not-for-profit doesn't mean you're not subject to unclaimed property. So this is any property held, owed, and unclaimed by the owner of that property after a dormancy period is presumed abandoned, and should be remitted to the state of the last known address. So examples of unclaimed property or outstanding checks like payroll or accounts payable, accounts receivable credits or refunds, insurance payments, tuition reimbursement, stock, gift cards. Again, states are sending notices. Keep in mind this is a serious issue. If you do get a notice, make sure you respond or seek professional assistance.
Also important to note, don't take it back into income.
Yes, good point. Excellent point. So with that being said, let's get to the next slide and pass it over to Jason.
Perfect, thank you. So now we're gonna jam a bunch of income tax topics into the next remaining time that we have. So we may go a little fast here on some of these topics, but hopefully some of you are very familiar with it, and we've done more extended webinars on each of these topics separately. So always feel free to tune into any of those if you'd like to get further analysis or thoughts with that. So thank you. So as we think about pass-through entity tax, right, in the past 18 months, we've seen a multitude of states enact pass-through entity taxes, also known as PTE taxes, right? These elections are in response to the $10,000 state and local tax deduction limitation that the TCJA put in place. Based on last count, I think there's about 29 states and one locality, that being New York City, with a PTE election, but many of these states enacting such a workaround in 2021. So considering that there's about 9 or so states without any owner level personal income tax, right? And there's about 29 states with these PTE elections, that leaves us only about 10 or so states that have not yet enacted PTE workaround, which is kind of unbelievable now. And the speed of that within the state and local landscape that these have been enacted and passed is really unprecedented within the past couple of years. These laws are designed to reduce the SALT cap effects on taxpayers without reducing state revenue. So there's definitely considerable disparity in the application of each state's PTE. Many of the states, though, do share many of the same characteristics, so we'll be talking about that in just a moment. But again, the common denominator with any PTE election is to produce a SALT deduction at the federal level. This is done by shifting the tax burden from the owner's individual return to imposing the tax at the entity level. Right, so by doing this, the flow-through entity is able to deduct on the federal return state tax expense, thereby reducing federal taxable income and its federal tax. So let's look at the next slide here. And this is really going to give you a full picture of what we've seen since really 2 years ago. And again, the theory of the SALT workaround is not to produce any additional tax revenue to the state. It's supposed to be revenue neutral while retaining a state and local tax deduction at the federal level that was always historically allowed prior to the Trump tax law that was enacted, I think about late 2017 it was, effective for 18. And again, the speed of how rapidly these have been enacted is really, really unprecedented. It's unlike any trend we've seen in state and local tax. After the SALT limitation was enacted and before the IRS provided any guidance if they would affirm the workaround, a handful of states started to offer the PT election, as you can see here. This is summer of 2020. Then in November of 2020, 6 days after the presidential election, the IRS issued Notice 2020-75, explaining that they intend to issue proposed regulations supporting the use of a PTE SALT workaround. This was certainly a taxpayer-friendly development that signaled to the states that individual owners or shareholders of a pass-through entity would not be limited in the amount of state and local tax that could be deducted. So looking at the next slide, and you can see basically as of today, May of 22, there's close to 30 states with a PTE SALT workaround. Without any doubt, there's this momentum of states passing PTE causes a lot of strain on state tax authorities, right? So you got to keep in mind that states now need to interpret the law that was just passed, release guidance, develop forms, instructions, implement their technology to be able to accept and process tax returns for this newly enacted tax. So as you can imagine, state tax authorities are extremely overwhelmed, and their ability to get out guidance is going to be constrained. Putting in place a brand new tax type and getting out and guidance on it can take significant time, let alone it could take many years for any case law to ever bubble up. So the guidance out there is going to be limited, and the states are learning as tax practitioners are learning. They have to learn the tax, and so do we. So do expect that there is going to be delay for guidance, right? You may say, hey, how is something treated? You have a unique fact pattern in Arizona or Kansas or whatever state, right? We certainly help clients interpret the law, but there's going to be unique fact patterns that unfortunately some of these states are just so limited in the guidance that it does make it sometimes difficult to analyze. And so looking at the next slide here, these are some of the primary features that you need to be considering if and where to make an election. So election number one, right? Obvious question, is it a mandatory election, PTE, or an elective tax, right? Few states, right? Connecticut, for example, it's going to be a mandatory state, but the vast majority of states that have enacted PTE since Connecticut, it is elective. So another question with election, right? You got to be thinking about timeline. When do you make the election, right? Many states, the election is going to be due with the tax return or based on the due date of the tax return, one or the other. Some states like New York, for example, it is due. The election is due 2.5 months within into the tax year, so you have to make that election early on. So in terms of election timing, and is it mandatory, the process, is it part of the tax return, is it separate from the tax return, right? You need to be considering all the mechanics and the administration when it comes to that. With eligibility, right, part of the analysis needs to include determination that the entity is eligible to make the election. Some states, right, some certain partner owner types might disqualify business from making the election, right? So think about what the composition of the partnership is or the S corp, and can you make the election? Are you eligible? Maybe if you have a corporate partner, if you have an S corp partner, it might disqualify you from making the election. So keep that in mind. State taxable base, when you're computing that, right? Each state's gonna have unique rules and how you allocate income. So when it comes to that, right? I'll give you an example. With New York, if it's a partnership, all of the residents' income, sourced and unsourced, right, is allocated to the state for purpose of the PTE. For non-residents, it's just going to include sourced income, while for S corporations, right, in New York, it's going to be a sourced income for both residents and non-residents, except New York just recently enacted a revision to their PTE, which does allow certain S corps that are only owned by New York residents to also compute New York State PTET based on all income that's sourced and unsourced. So that's just one example in one state. We could go through a lot of these states and there's going to be a lot of complications, but keep in mind that state taxable base is going to be an important concept here. And then lastly, with owner offset, in order to prevent double state taxation, right, because again, this is supposed to be revenue neutral, states are generally going to either use two methods to mitigate a second layer of tax, right? And that's either going to be a credit mechanism, which essentially passes a credit to the partner owner for the distributed share of tax paid at the entity level. And then other states are going to use an income exclusion approach, which just essentially puts a block on the income that would normally flow up to the partner owner. So there should not be, in theory, there should not be a second layer of state tax as a result of making this election. Now, of course, there can be unique circumstances where that doesn't always happen in the perfect world, but in theory, there should not be a second layer of tax. So that's what the owner income offset is. Now, looking at the next slide here, there's certainly going to be various risks that you need to take into account. I'm not going to read through all these, but keep in mind, one of the items that's definitely where there's lack of guidance out there, and I think there's a lot of variation depending on who you speak to, the tax benefit rule, which could apply at the federal level. To date, the IRS has not provided any guidance if a business elects into a state PTE that produces, a refund at the individual owner's level, which could potentially trigger the tax benefit rule. Now, so keep in mind, right? So if you have a taxpayer, for example, that files, elects the PTE and files, and then at the individual owner level, there is a refund. And usually there might be a refund because of a resident credit, right? The PTE might have sourced income in other states. Maybe they're electing PTEs in other states, maybe not. And due to the resident credit in the home state, that could produce a refund, right? For example, in New York, if you're a resident and you're getting 100% of your income sourced in New York, your PTE is going to be significant. But when you file your New York return and you're getting a resident credit for other states' tax that was paid, then that resident credit could result in the PTE being somewhat refundable. And as a result, potentially that could trigger a tax benefit rule. So that's something that needs to be considered. That doesn't mean that it completely negates the benefit of electing a PTE, but it is another variable that needs to be considered when analyzing what states to elect a PTE in or not. Looking at the next slide here. So these are some action items. I mean, the key point here, right, is that PTEs are very new. It's going to take years for businesses to really get their hands around each of the statute's rules, but it certainly could be a game changer, right? You could save significant money. You just have to make sure that you're doing all the analysis. So we certainly recommend for any structure that where that you might be considering electing in multiple states, and you might have a big partnership in terms of partner composition or significant shareholders as part of an S corp. We strongly advise, right, that everything's modeled out, right? You really have to model it out. You need a matrix. You need to go through all the state rules. You need to understand all the moving parts, understand the composition of partners, and go through all those variables, because every business is going to have their unique facts and circumstances, and a one size fits all, right, is not going to apply here. So that's what is number one, is to model everything out and make sure you understand the rules and see where it could be favorable, where there could be potential pitfalls. Looking at the next topic here, with telecommuting. And as I said, we're going to go through this quickly. So let's see if we go next here. So we're going to spend a few minutes and talk about the impact of telecommuting in respect to the healthcare industry, because we've had plenty of clients in the healthcare industry that have been impacted by this. And so, we know that the effects of COVID telecommute is not going away. And, though a significant pool of employees were already maybe telecommuting pre-COVID, obviously COVID essentially changed everything. So you can see that, it's been a success, and you can look at the next slide here, right? And basically what these graphics are telling us is remote work is here to stay. Question is, what is it going to look like, right? Will it be a hybrid where we're in the office 2 days a week, or home 3 days a week, or twice a month, right? We know that remote work is here to stay, and it's going to be different for every business. And you can see based on some of these different surveys that are out there that are shared publicly, it's been viewed to be a success. And so from a SOL perspective, right, with remote work, there's going to be many implications that we need to be considering as we move forward, because it's here to stay. It's not going anywhere. And if we go to the next slide, and this is continued, surveys here. Let's flip to the next one here. And we're going to quickly go through this. But as we're looking at some of these surveys, I'm going to comment real quickly, right? Some of the things that we need to be thinking about from the SOL perspective when it comes to telecommuting. The three that I would say is nexus, right? Income tax apportionment, and state payroll withholding, right? So it could impact, obviously, if employees in the state, that clearly could impact sales tax and income tax apportionment, right? How you calculate state source income, how you calculate, right, how much goes to one state from another state, and every state has different rules. But how you slice up that pie is going to differ, and employee location is going to impact potentially a state sales factor with cost performance, or a payroll factor, right, where the employee is working. So there could be huge implications. And then, as I mentioned, with state payroll withholding, right, could be huge implications as well, which I think we'll talk about a little bit more in depth in just a moment. So if we go to the next slide here.
We're on to our third polling question. A reminder, after this one, we have still one more. Have you considered the nexus implications for telecommuting? Yes, no, not sure. What is nexus? Reminder to get your votes in. It'll be up for about 20 more seconds. All right, I'm gonna go ahead and close it out. And here are the results real quick.
Okay, yeah, so it looks like evenly split. Yeah, so definitely want to make sure you're considering that, because it can have a huge impact. So as we continue talking about telecommuting here, right, first and foremost, as I mentioned, right, income tax and sales tax nexus, relatively straightforward. You have an employee of the state, you're gonna have nexus. Secondly, with apportionment, right, and again, essentially this is a state's formula used in dividing up or allocating taxable income amongst the many states. And essentially, right, it can impact the sales factor, because the sales factors could be, depending on the state rules, based on where the employee is working, could impact the payroll factor. So big implications with that. And then last, with the as I mentioned, with the payroll tax withholding, again, traditionally a lot of states will require withholding where the employee is working, but certain states like New York, which employs a convenience of employer rule, in those kind of states, right, essentially will require non-resident wages to be sourced to the office of the state where the employee is assigned, opposed to where the employee is performing employment services. So this could potentially result in double withholding requirement for the employer based on the facts and circumstances of each employee. So employers certainly need to be developing policies that are aligned to managing, withholding risk objectives. So you got that. Now, if we continue on, so traditionally speaking, right, most states, as I mentioned, they're going to source where the employee is working. Now, of course, if there was some COVID relief, which I think most of that, there could be exceptions, which I think most of the COVID relief is expired practically in every state. So I don't think that's going to be applicable anymore. The effect of having employees working remotely on a temporary permanent basis, regardless if they're there for 3 months or they're there for, permanent going forward, right? You need to be thinking about all the potential nexus implications and all the other subsequent implications that come with that. Now, if we go to the next slide, and this is really important to highlight, right, with the convenience of employer rule in New York. And, again, these rules, when they come into play, they don't impact, right? If the employer follows and complies, they're not going to impact the business because this comes out of the pocket of the employees. But when the employer doesn't comply, this could negatively impact the employer because the state could potentially go after the employer, the employee, or both. And so, if you have an employee assigned to, let's say, the New York office, for example, under the state's convenience of employer rule, and they spend at least 1 day physically in the New York office, then they could potentially be subject to the convenience of employer rule in New York. Now, some exception to that would be is if the remote office of the employee, where they might be working out of, satisfies a bona fide office exception. And so when you go through the bona fide office exception guidance from New York State, which gets very complex, a lot of our clients have difficulty meeting those exceptions, and so it's really important to go through them and get comfortable, because in most instances, I would say it is a challenge to meet those exceptions. So it is something to keep in mind. Now, when I say, I just want to make sure I highlight, when we talk about an employee being assigned to an office, that's not going to be just assigned to the New York office on paper, right? Some of the things that New York State, for example, might be looking at is, who does that employee report to? Who does their performance reviews? Right? If they work in the HR department or they work in the IT department, where do those employees work? Are they generally based in New York and working in New York? So it's going to be based on facts and circumstances. It's not just on paper what office they're assigned to, but actually in reality who they're reporting to, and directly, indirectly. And so there's a host of different subjective analysis and variables that need to be taken into account when it comes down to this. And now, as we flip over to the next slide here, with telehealth, right? And let's go flip to the next slide. From an income tax standpoint,
Sorry, we just have our fourth and final polling question. Have you hired telehealth providers in new states during the past year? Yes, no, not sure. I can't tell where these providers are located. All right, leave it up for about 20 more seconds. Reminder to get your votes in. All right, I'm gonna go ahead and close it out, and it looks like the majority voted no.
Okay. Great. So as we wrap this up, right, what I will say is that, traditionally speaking, when a clinical care was provided as an in-person service, it was easy to identify those receipts, those revenues, how to source it, right? In-person services, clearly much easier, generally going to be sourced at the site of the location of the patient's services. However, now when you have telehealth with a medical provider, let's say in state X, providing services across state lines with a patient statewide, maybe an insurance company in state Z, right? Question now becomes how and which state does the business source the revenue to? And again, it's going to just be, it really depends. Every state has different rules. Some states have special industry rules, other states don't. What is their guidance? Is there case law? And so on, right? In the perfect world, all the states would have the same sourcing rule and the revenue would only be sourced to one of the states. However, right, it's possible that none of those states are going to claim that revenue from the transaction, or it's possible that all the states claim the same receipt in that transaction. It just depends on the rules of each state. So again, when it comes to telehealth, we need to be thinking about these kind of variables, such as where do we look when we source revenue, right? Is that billing, where the patient's billed, or where they're located, where the clinical services being taken place. So, lots of variables. Now, if we look at the next slide here real quickly, again, you can see the payroll, right? The sales and the property factor. Those are the things that I mentioned earlier as part of the apportionment calculations. That's what we need to be taking into account. If we look at the next slide, as we wrap up in just a second, I just want to show, give a little bit of a visual here, is that, as I mentioned earlier, right, states have been trending towards market-based sourcing, and you could really see this in 2000. There was only a few states at most. It's really interesting to see it in a graphic. And then if we look at the next slide here, look at that. So you can see the changes over the 20 years and what the trends are. If you look at the next slide, so Jib, so I guess, if you want to chime in here and help us wrap it up, the things that we need to be thinking about. I know we covered the topic quite quickly today, some of them, but things that we need to be thinking about in terms of next steps.
Yeah, absolutely. And what we suggest is perform a sales and use tax process review, looking at your exemption certificates for completeness and validity. Purchasing procedures, make sure you are paying sales tax on purchases for-profit entities and not paying sales tax on purchases for not-for-profit entities. And then sales tax collection procedures is if you are selling a not-for-profit selling or a for-profit selling to customers, make sure you're aware of the taxability and your collection responsibilities. If there's internal allocations of technology or mixed use assets, make sure you're setting up a sales tax process or a use tax accrual process as well. Make sure you review your unclaimed property policies and procedures and exposures and consider a voluntary disclosure agreement, which could be available in some jurisdictions. Consider the SALT workaround planning opportunities that Jason had talked about, and analyze the effect of telecommuting employees on both sales tax and income tax. And then, of course, review your sales use tax and income tax implications for telehealth or other services. So again, if you take a look at this, if you have any questions, next slide, please. If you have any questions, again, feel free to reach out to any of us. We're more than happy to help. Again, thank you for joining, and we appreciate you spending the time with us.
Thank you, everyone. And as a reminder, a recording of the session and the PowerPoint will be emailed out to everyone. Thank you.